You know that feeling, right? You pull up the Fibonacci tool, you draw the lines on your chart, and you watch the price just blow right through those so-called magic levels. It's frustrating, and honestly, you're not alone. So many traders struggle with it. But what if I told you the problem isn't the tool at all, but how we're all taught to use it? Let's get into it.
Yeah, this is the big one, isn't it? Why does this happen? Well, traders learn to draw the lines, they see the levels, they jump into a trade, and then, poof, the setup just falls apart. And the reason really is a huge misunderstanding of what Fibonacci is actually telling you. It's not a crystal ball, not by a long shot.
And this, right here, is the absolute core of what we're talking about today. The source material is so clear on this. Using Fibonacci all by itself is basically a recipe for disaster. Its real power, its actual strength, is only unlocked when you combine it with other things.
So here's our game plan. We're going to start by totally debunking the myth. Then we get practical. We'll cover how to find your entries, how to build those really high probability setups using something called confluence, what to do in strong trends, and of course, the most important part, how to actually secure your profits. Okay, first things first, we have to completely reframe how we think about this tool. Let's just rip the Band-Aid off. Fibonacci is not some mystical signal that just prints money. It's a tool, plain and simple. And like any good tool, you have to know what it's for.
I love this analogy because it's just perfect. Think of Fibonacci as drawing a roadmap of potential, keyword potential, areas where the market might turn around. But it is not a self-driving car. It is not going to make the decisions for you. You are still the one in the driver's seat, and you still have to read all the other signs on the road.
All right, let's get our hands dirty. The first practical application we need to nail down is the retracement tool. Its entire job is to help you spot these high probability, high value areas inside a trend where you might want to start looking for an entry.
Now look, forget trying to memorize a dozen different numbers. Let's just simplify this and focus on the ones that really matter. A 50% pullback? That's good. We like to see that. The zone between 50 and 61.8%, that's what we call the sweet spot. That's great. And the 61.8% level itself, that's the best of the best. That's a prime area where the big money often starts to step in.
Okay, and this is a rule you absolutely cannot break. Price almost never respects a perfect single pixel line on your chart. You have to think of these levels as general zones or areas. Price might poke through a little or stop just shy. So the most important part is this. You have to wait for confirmation from the price action, like seeing a specific candle pattern, before you even think about risking your money.
So how do you actually draw it on the chart? It's super simple. Seriously. First, you just find the last major push-up, that's the impulse move. Then you grab your Fibonacci tool. You click on the very bottom of that move, the swing low, and you drag your mouse all the way to the very top, the swing high. That's it. You've just laid down your map of potential support zones. All right, now we're getting to the good stuff, the real secret sauce. If using a fib level by itself is so unreliable, how do we make it powerful? Well, the answer is a simple but amazing concept called confluence. And trust me, this is what separates the pros from the amateurs.
So what the heck is an area of confluence? It's really simple. It's just a spot on your chart where multiple, different reasons to take a trade all overlap in the exact same price zone. Every single reason you add just acts as another layer of proof, and it dramatically increases the odds that your trade will work out.
Okay, let's build one of these from the ground up, step by step. So you've drawn your Fibonacci levels, and price is coming down to that 61.8% retracement. That's layer one. It's a good reason to pay attention, for sure, but it's not enough to risk our hard-earned money on. Not yet.
But now, watch what happens. Let's add a second layer. What if that same 61.8% level also lines up perfectly with an old swing low on the chart, a really clear horizontal support level? Whoa. Suddenly, our setup is way stronger. Now we have two totally separate, independent reasons for price to bounce right here.
And here's where the magic really happens. For our final layer, what if a major moving average, like the 50 period, is also cruising right through that exact same spot? Now you've got the trifecta, a key fib level, a strong support line, and a dynamic moving average, all converging. That is a high-quality area of confluence. That's a spot where you can trade with some real confidence.
Okay, but we've all seen it, right? The market is just taking off like a rocket. It's not pulling back to those deep 50 or 61.8% levels. So what do? Do we just sit there and miss the whole move? No way. This is where a very specific special case level comes into play.
You have to match your approach to what the market is actually doing. In a normal, healthy trend, yeah, we're looking for those deep pullbacks to get in at a good price. But in a really strong, momentum-driven trend, the pullbacks are shallow. Buyers are just piling in so fast that the price barely even dips. In these cases, the 38.2% level becomes our new best friend.
But hold on, you can't just use the 38.2 level whenever you want. The source material points to two very specific scenarios. First, when that 38.2% level is part of a powerful area of confluence, just like we talked about. Or second, when that shallow pullback happens right after a major trigger event, like a huge breakout from a chart pattern, that confirms the market has some serious momentum behind it.
Look, getting into a good trade is only half the battle. Knowing when to get out, that's what actually makes you money. So for this, we're going to flip the script and use the Fibonacci extension tool to project potential targets out in front of us.
Your first major area of interest for taking some profits off the table is the 50% extension zone. Now remember, this isn't a retracement, this is a projection forward. Think of it like the first checkpoint on your road to a profitable trade.
So, why this level? What's the psychology? Well, it represents a point where the current move has now traveled half the distance of the last big impulse move. It's just a logical first stop where a lot of the bigger traders, the big boys, are going to take some chips off the table, and that can cause the price to pause or even pull back.
Now, if the price just slices right through that 50% zone with a lot of power, the next major destination on our map is the 100% extension level. This is often where a trend can start to run out of gas.
And the logic here is it's so elegant and simple. A 100% extension means the current push has traveled the exact same distance as the last one. It's a point of symmetry. At this point, the price is often considered overextended, or at an extreme, the trend might be exhausted, and the risk of a major reversal goes way up. It's an absolutely fantastic area to secure the rest of your profits.
Okay, let's boil this all down. If you walk away with anything today, make it these 4 rules. Rule 1, it's a map, not magic. Rule 2, always, and I mean always look for confluence. That one's non-negotiable. Rule 3, use the right tool for the right job. Retracements to get in, extensions to get out. And rule 4, adapt to the market. Deep levels for normal trends, shallow levels for the really strong ones.
And that leaves us with a final and maybe the most important question. We've established that Fibonacci is an incredible tool for showing you where to look for a great trade, but the tool itself is never, ever going to tell you when to pull the trigger. That is the job of your complete trading strategy. So, is yours ready?